Have you ever wondered what would happen if a US Treasury auction failed? In other words, what would happen if the US government tried to borrow money and there were not enough lenders there to lend them the money they wanted to borrow? While many people think this is a scenario that could absolutely never happen, especially because we have something called the Federal Reserve that prints money. If we take a look at a couple of key pieces of data from recent Treasury auctions over the last few months, it is becoming apparent we are actually getting closer and closer to that becoming a reality. In October of 2023, a 30-year Treasury auction had a 3.7 basis point tail, and dealers were left with holding 18% of the float. And don't worry, if you don't know what any of that means, I'm going to explain extremely simply why all of that is a terrible sign for US Treasury auctions. But first, we have to see that just a month later, in November of 2023, the 30-year Treasury had an even worse auction with a tail of 5.3 basis points, and dealers left holding 24.7% of the issue. But it's not just the 30-year auctions, because in January of this year, the US Treasury had trouble with their 5-year note auction that had a 2 basis point tail and a bid to cover ratio of 2.3. And most recently, in February of 2024, the 20-year US Treasury had a tail of 3.3 basis points, which was its largest on record. Dealers were left holding 21% of the auction, and foreign bidders dropped to 60% from November's level of 74%. But that's a bunch of mumbo jumbo, a bunch of industry jargon, so what in the world does that all mean? Don't worry, I've got you. When the US government wants to borrow money, they do so through the Treasury Department. The Treasury Department is the one that will borrow by issuing bonds that we call treasury bonds, or in other words, treasuries. And they do this by holding an auction. Essentially, the US Treasury says, hey, we want to borrow, let's say $1 billion, and we want to pay, let's say 4% on the $1 billion that we're gonna borrow. There are two groups of people that can participate in this auction. There are individuals and there are institutions. Individuals like you and I can line up if we want to, and we can say either, yes, I would like to loan you money, Uncle Sam, at 4%, or we can walk away and not participate. But those are our only two choices. We can opt in or opt out. Institutions, on the other hand, have a third choice. Institutions can opt in to the 4% that the government is trying to borrow at, or they can opt out, or they have the third option of saying, we want to lend to you, Uncle Sam, but only if we can do so at a higher rate than what you're asking. So maybe institutions say, I'll lend you money at 4.01% or 4.02%. Well, just like any borrower, you're going to go with the person who offers you the lowest rate, at least first. And I say first because for you and me, we may only need one lender when we're trying to borrow money. But the US government has a pretty big appetite for borrowing. So most of the time, they're going to soak up all of the individuals and all of the institutions that line up and say, hey, we're willing to lend to you at the rate that you requested. Their appetite's pretty big, so they're gonna burn through all of those lenders first. After they've borrowed all of the money from everybody that agrees to the original rate, they'll probably still need to borrow some, and then they'll look to the institutions who have offered to lend at a higher rate. They'll start from the bottom and work their way up until they've borrowed everything they need for that auction. So if they start off wanting to borrow $1 billion and they can get 500 million of it at the rate they wanted, let's say 4%. Now they have 500 million left over they need to borrow from institutions who are asking for a higher rate. They'll start at the lowest rate and work their way up until they have borrowed enough. The key thing to know about these auctions, though, is that everybody in the end actually walks away with the same exact rate. And that's the rate at which the last person got to lend to the government. And so if that last person, that last institution in line lending to the government gets to lend at, let's say, 4.05%, then the US government will have to pay everybody that exact same rate. Everybody that participated in that auction gets what's called the high yield. The difference between what the government wanted to borrow at, let's say 4%, and what they ended up borrowing at, let's say 4.05%, is called a tail. Sometimes auctions go with zero tail, which means they're able to borrow as much as they wanted to borrow at the rate they wanted to borrow at. And sometimes auctions happen with small tails. Recently, we've been seeing more and more auctions happening with larger and larger tails. In October, the 30-year had a 3.7 basis point tail. In November, the 30-year had a 5.3 basis point tail. And in February, the 20-year had a 3.3 basis point tail, which was the 20 years largest tail on record. Obviously, the larger the tail, the worse the auction. If you were trying to borrow at 10%, but you could only get lenders to approve you for 11 or 12 or 13%, that wouldn't be good for you. It's the same thing for the government. And a large tail can signal a couple of things about the financial system. Number one, it can signal weak demand. For one reason or another, lenders just don't want to lend as much money to the United States government. Number two, it could signal lack of faith in the government's fiscal situation, which means I don't trust that you'll be able to pull your way out of this without causing significant inflation, so I'm not going to lend at the lower rate. I'll only lend if I can get a higher rate. Number three, it could signal a lack of liquidity in the financial system, meaning maybe somebody's out there that would like to lend at the government's requested rate, but they just don't have the cash on hand, the reserves available in order to do that lending. And finally, it could also signal a lack of actual lenders in the system, like when foreign lenders stop participating and there's just a lack of money available because there's less lenders in total. And over the last couple of quarters, it's become clear that this is a recurring theme. We're seeing larger and larger tails happen at a more frequent pace than we have in the past. So let's talk about three questions that we have to answer because of this. Number one, why is this happening? Why are we seeing larger and larger tails? Number two, when or will it get worse? Is this a deteriorating situation or is this something that has just passed? And number three, what would happen in the case of a worst case scenario, which would be a failed Treasury auction? And there's much more about this than I can cover in a quick YouTube video. And so on Thursday, March 7th, I'm going to be hosting a completely free live online event. We're going to be talking about this, but also how it fits together in the context of everything else happening right now. With the Federal Reserve trying to fight inflation, but also is going to have to be the one to be there to save the financial system when this starts to break things. We're going to be looking at all of that together in context with the broader long-term debt cycle, because these things have played out many times throughout history. There's a pattern at play here, and we're seeing it play out again right now, which gives us a better idea of what to expect moving forward. And above all, we're also going to be talking about how to profit off of everything that's happening right now. It's going to be about a 1-hour event, so make sure you set aside time on your calendar. It's going to be on the evening of March 7th, and it's actually limited in space. There's only 500 slots available, so if you are interested, don't wait. Link is in the description below. The reason why the Treasury auctions are getting worse and worse right now has to do with a couple of reasons. Number one, foreign lenders are not participating as heavily as they used to. We can see in this recent February auction, foreign bidders dropped to under 60%, whereas they used to be upwards of 74% in November. Another reason this is happening is because the Federal Reserve so far is still doing quantitative tightening. Quantitative tightening is the process by which the Federal Reserve allows its balance sheet to decline. A lot of the Federal Reserve's balance sheet is made up of US Treasuries, which means the government owes money to the Federal Reserve. Quantitative tightening is when that money gets paid back. The Federal Reserve doesn't take all of those dollars and lend them right back to the US government. Instead, they allow some of that debt to get fully paid off. Those dollars don't just sit on the Fed's balance sheet, they just get destroyed, they cease to exist. So as the Federal Reserve's balance sheet moves down, that represents less and less liquidity in the financial system, and the government has to find new sources to borrow that money from. The third reason why is because the federal government is actually ramping up how much money it is borrowing. So while the Federal Reserve is not there to be as big of a lender, and while foreign lenders are not there to be as big of a lender, the government is actually trying to borrow even more, despite the fact that there's less lenders. So that's why this is happening right now. So the second question is this going to continue to get worse? At least in the near term, we are very likely to see continuing bad auctions as long as the federal government is borrowing at the long end of the curve, auctioning off 20-year treasuries, or 30-year treasuries. Liquidity is simply drying up for debt like this, especially considering the growing likelihood that we are entering into a new higher inflation environment for the long term. However, the government currently can borrow at the short end of the curve, pretty much anything under a year, without having to worry about liquidity issues. And this is because there's still about $500 billion in excess cash in the financial system that's sitting in the reverse repo facility. And so if the government continues its borrowing at the short end by issuing T-bills instead of borrowing at the long end with things like 20 or 30-year treasuries, they'll continue to suck more and more cash out of the reverse repo facility until it's drained. Now, this $500 billion could go very quickly. There are times when the reverse repo facility drops very quickly, or there are times like right now when it kind of stagnates and doesn't really drop at all. But given the issues with the government borrowing at the long end and the lack of issues with borrowing at the short end, they'll likely continue leaning on the short end with things like T-bills for the majority of their financing needs, which means that it's just a matter of when, not a question of if, the reverse repo facility gets completely drained. And once that happens, the government will lose yet another source to borrow from, and they won't have a specific area of the yield curve they'll be able to lean on for their financing needs, which means we are likely to see an acceleration of issues in the treasury market, not a passing of these issues. This will have the effect of pushing interest rates much higher, draining liquidity out of the financial system, and increasing the problems that many small banks are facing right now. Which means the last question here that we have to deal with is what happens if it does push things to the breaking point? What if a treasury auction happens and it fails? A failed treasury auction simply means that the government tries to borrow a specific amount of money and not enough people line up to lend to them. For instance, if they wanted to borrow $1 billion, but only $900 million lined up to be lent to them, it doesn't matter what rate the lenders are asking for. It's a failed auction because they tried to borrow a certain amount and couldn't. Not only that, but that auction would probably have a massive historic sized tail because that last lender that lined up could technically, theoretically ask for any rate and they'd get it. A failed treasury auction, however, does not mean that the government defaults. The federal government has their version of a checking account called the Treasury General Account that is currently sitting above $700 billion, which means if they do have a failed auction, it'll certainly be bad for treasury markets and probably the stock market as well. We're probably going to see massive dislocation and disorderly conduct all throughout financial markets as the safest asset in the world just experienced a failed auction. But it doesn't mean a default. They'll simply just need to spend some of the money from their checking account, the Treasury General Account, to make up the difference. And at that point, we are very likely to see a return to quantitative easing, where the Federal Reserve starts to increase its balance sheet again, instead of decreasing it like it's been doing for the past few years. That's where they print money, use that newly printed money to buy treasuries from banks so that banks can then turn around, take that new cash, and loan it to the government. At the end of the day, this is the only option. It's the only way forward. Government borrowing is not slowing down anytime soon. It is only a matter of time before they tap out the liquidity in the markets and we need the money printer to fire up yet again, which means the government will be able to borrow at whatever rates they need because they're essentially borrowing indirectly from the money printer. But for everybody else like you and I, that'll push up inflation because the government will be spending money into existence again. Prices will go up, which means lending rates and borrowing rates for everybody else like us will actually go up. We are in a new phase of the long-term debt cycle. Everything we're seeing playing out right now very much mirrors what happened in the 1940s through about 1980. This is going to be very different than what has happened for the last 40 years, which took place from about 1980 through 2020. The rules of investing and making money, they change given where we're at in this long-term cycle. We're going to be discussing all of that and much, much more in this free live event webinar that we're having on March 7th. Mark your calendars. It's going to be about an hour long, completely free. There's only 500 slots available though. Link is in the description below. Don't wait. Sign up now. See you there. As always, thanks so much for watching. Have a great day.